Welcome everyone to our newest webinar in our Capital Insights series. Thank you so much for joining us today. This series is meant to provide information and have a discussion on topics related to funding your innovation startup to help entrepreneurs expand and scale their business. Today's session focuses on alternative funding routes and why to consider them. I'm Petra Stegman, the Senior Director at Connect, where I lead our Springboard program. Connect is a nonprofit organization created some 30 years ago. Since then, we continue to work with life science and high-tech entrepreneurs to help them grow and scale their companies through the various programs we offer. We have an exceptional panel lined up today, so let's get started. It gives me great pleasure to introduce today's moderator, Andy Ballister. Andy is a co-founder of GoFundMe, a personal fundraising platform which has helped people raise tens of billions of dollars for the causes that matter most to them most. The company launched in 2008 and rebranded to GoFundMe in 2010. After bootstrapping the company for 7 years, in 2015, he and his co-founder sold their majority stake and moved into board positions. Excuse me. Since then, Andy has been active in the San Diego community as an angel investor and mentor and advisor to many local startups. He tells me that he's working on a new AI tech startup, still in stealth mode, so stay tuned. Welcome, Andy.
Well, thank you. And hey, everybody, I'm Andy Ballister. Really excited I get to help out and talk about alternative capital sources. As you know, we built up GoFundMe to over $1 billion raised for our users, 100% bootstrapped. I've been mentoring startups here in San Diego for about 7 years, and I often talk to them and ask them the question, could you bootstrap this idea at least to a point of sustainability? What would that take? Sometimes depending on the audience, it's not a very popular question or line of thinking, but it made sense for us at the time. And it made sense for us personally with the experience we've had with previous investors in startup life. It also made sense to us because we started in 2008. It was also a really tough time to raise money out there. And so, on the question of what would it take for Brad and I, it took us essentially becoming a dev agency for 3 weeks out of the month to keep the lights on and pay rent as we built out our own product and was able to start to build an audience in the hopes of, hopefully making this a real company. And as we were able to shift over, we were able to put more and more emphasis on our own product. It forced us to be extremely lean and to fiercely prioritize what we did. And when we got to a place where we could hire folks, we were extremely picky about who we brought in because we knew this was going to be, one of very few people we could bring into our lean startup. So we have lots of great alternative capital stories here. I'd love to turn the mic over to Anna to talk about how she approaches looking at capital for her startup.
Thanks so much, Andy. So hi, everyone. My name is Anna Moreno. I am the CEO and co-founder of Navega Therapeutics. So we are a biotech company. Just a quick story of how we started. I did my PhD in bioengineering at UC San Diego. And I was working on a platform for gene therapy focused on a variant of CRISPR. I'm sure maybe some of you have heard about CRISPR. It's a tool that we can utilize to modulate the genome. But specifically for me, I was focused on using this tool set where we're not permanently mutating the genome, but we can do epigenetics, which means we can turn genes up and off. After using this platform and applying it for chronic pain and seeing really exciting results, I decided to start my company as a grad student, as a PhD student. And so what I first did was look around San Diego, look at opportunities in terms of pitch competitions, actually. So how can we actually get the first dollars so we can actually incorporate the company, make this a company itself? I had the opportunity to participate in some pitch competitions at UC San Diego, as well as in the city of San Diego itself. And that's what brought us our first 100K, both for in-kind services as well as some cash. And what we thought about was, how can we de-risk the technology further to make it more attractive for investment or for grant funding? And so with some of that money, we took that money to show safety in animal models, but also to incorporate the company and find IP lawyers to start licensing the technology. At the same time as I was doing my PhD, I also started applying for non-dilutive funding through grants. And so the NIH has some small business innovation research grants that I took advantage of. We applied for 2 different grants. I graduated in April 2019, and the money came in September. So I was a postdoc for only a few months, but that $1 million allowed us to get out of the university into incubator space at JLabs. So that's how we got started.
That's excellent. Thank you very much. I'd love to bring in John and tell us your funding story.
Thanks, Andy. Hey, everybody, this is John. I'm the CEO and co-founder of Gryphon. We are a mission-oriented, family-first cybersecurity company. My background has been in wireless and IoT. I've been in that industry for about 28 years now. Originally with a local company here called Novatel Wireless, where we developed the MiFi mobile hotspots. And the reason I started the company was because of a horrible incident with one of my daughters, where she was searching for stuff on the internet on her iPad, and a bunch of inappropriate stuff came up. And as a parent, it was one of those moments where I felt like I needed to do something. And so Gryphon was a result of that. The way we kind of started Gryphon was we basically started funding it ourselves. So we kind of bootstrapped in the beginning, but we knew that wasn't enough funding to be able to actually launch the product. So we actually did a Kickstarter campaign. So we ran a Kickstarter campaign back in 2017. It was moderately successful. We raised about $80,000 from the Kickstarter campaign. It was still not enough to actually produce the product. There's mechanical engineering, there's prototypes and things that need to be done, and then products that has to be made. What we did was basically, once we took that and basically developed the product to a point where we could actually commercialize it. But to actually fund the actual commercialization of the product, we did another, this was more of an equity crowdfunding campaign, which we did on Seed Invest. And this was basically a CF, I don't know if you guys know, but it's a Regulation CF round. And we were fortunate enough to be able to raise close to a little bit over 900,000, which was the maximum at the time for a Regulation CF round. And that really helped us to launch the product. And we got onto Amazon, started selling online, and then we started to grow from there. And then eventually in 2020, we also did another equity crowdfunding campaign to scale the business. This was during COVID, and we did a regulation, what's called a Regulation A+ round, where we raised a little bit over $6 million for that round to be able to scale the business. So it was a combination of just, and the reason we did equity crowdfunding was because it kind of gave us a little bit more control on when we can actually raise the capital. We did talk to angel groups as well, and also venture capital, a little bit of that, although COVID kind of put a squash to it early on. But it really, doing the equity crowdfunding helped to really validate the business and validate the fact that we do have customers that love the product, and a lot of the funding actually came from our customers that not only bought the product, but they really believed in the mission of what we're doing to protect families.
Excellent. All right, and next I'd like to introduce Denise, and if Denise, you can tell us a little bit about yourself and how you interface with startups.
Okay, yeah, so I come a little bit more from the traditional funding side in venture. I'm a venture capitalist with Lonely Capital. We invest in early stage technology opportunities, primarily at the seed stage, and then follow on heavily on at the Series A. We have a regional focus here in San Diego, so most of 80% of our portfolio is actually here. But I founded together with my partner, Lonely Capital, so I know the fundraising journey, both from an investor perspective, but also from going out into the markets and raising capital.
Excellent. And if we could stay with Denise, let's just talk about, that more traditional capital route first, and if you could just kind of give us a high level overview of the various stages that you see in funding and where and how startups should think through where they're at and who they should approach.
Yeah, no, that's a great question. And just in context too, and I don't know where the audience sits in terms of knowledge, but the funding cycle looks a little bit different depending on what industry you're in. So when you've heard from Anna in the biotech space is quite different than the technology space I'm in, just because of what investors look for from a revenue perspective or not, or it's a regulatory perspective. But generally speaking, when the cycles traditionally are that if you're raising outside capital, you first source of capital probably comes from a personal source, that's friends and family, your own capital, if that's a possibility, or a crowdfunding solution like John just talked about. And then as you build your company, you then look to more institutional investors being venture capitalists. Although I will say, in today's world, you have family offices that invest in venture as well. So that's an avenue that some can take too. And those investors span from seed or even pre-seed all the way to late stage kind of capital for the exit. And different firms, generally speaking, will have a focus specifically on a certain stage. As I mentioned, we are more in the early stage, but then you have other firms locally, for example, GMI, who sits more in the later stages. Along the way, I think we've also built some other, the ecosystem has built some other revenue, funding sources. There's companies that fund, they're not venture firms, but they fund on revenue. So if you have revenue already, and especially if it's a recurring revenue model, there's companies out there, they'll fund on that. There's venture debt, less so currently with all the banking turbulences we've seen, but there's an option for venture debt, which typically follows venture capital. So a lot of the venture debt firms or banks will require that you've raised some institutional venture capital in order to tap into that market as well.
Excellent. And I see we have a question. How do you mentioned family offices? Is there a way to get access to family offices that invest? How would one go about kind of canvassing who to approach for a startup opportunity?
It's a great question, and unfortunately I don't have a great answer. Family offices, unlike maybe venture firms, are not as publicly, I guess, data-based, and they don't all market themselves heavily to the public. So finding out information on them in terms of what they're interested in investing in, if they even invest in this space, is actually rather hard. So it's similar if you have experience with going to high net worth individuals or angels, finding them is about the similar path of finding family offices.
Awesome, thank you. Yeah, I've run into that difficulty with some of the startups I've advised in the past. John, you talked a little bit about equity crowdfunding. I'd love to dive in a little bit deeper there. Could you maybe first go a little bit deeper on what is equity crowdfunding? I'm seeing some questions in the crowd there on that one. And maybe give us a little overview of what's the difference between Reg CF versus Reg A on the crowdfunding side. Oh, you're muted still, sorry.
Okay.
Awesome.
Yeah, that happens a lot. Equity crowdfunding as opposed to crowdfunding in general is a little bit different. So crowdfunding, like Kickstarter crowdfunding, it's more about pre-ordering the product before you actually launch the product. I saw there was a question about FDA approvals too. I don't know about medical devices, but in terms of selling the product before you actually have the product ready to be able to be sold, shipped. So Kickstarter is basically the people are pre-ordering the product. Equity crowdfunding is people are investing into the company, either through a safe note or in some cases it's actually preferred shares or shares of the company. And so equity crowdfunding, basically there's some process that you have to go through, and there's two different types. One is regulation CF, which is it's a lower amount that you could raise per year. Right now it's up to 5 million. It used to be 900,000. They raised the limit to 5 million about a year ago. And there's a little bit lower requirement as far as reporting to the SEC. So the financial does not have to be fully independently audited. You can have an accountant actually do the financials, or CFO of the company do the financials and do the self-reporting. There's a little bit lower legal hurdle as well to file for that. So that allows you, basically, once you file for it, that allows you to raise capital from both accredited and non-accredited investors. And you can also market the investment. So you could put it on Facebook, you can email all your friends to invest in the company. And they could invest as little as, I've seen $50 in the company versus, there's a few $100,000, right? So smaller investors could jump in and invest in the company for the equity crowdfunding. Reg A plus equity crowdfunding, it's basically you can raise even more capital. Now, I think right now you can raise up to 75 million a year on Regulation A plus, but there's a higher level of requirement as far as reporting. So with the SEC, you have to do independent financial auditing, almost as if you're listing the company public. And also you have to go through a full legal due diligence. And then you have to file your offering with different states for the blue skies clearance, right? So, and that costs a lot more, but you can raise a lot more as well. So it's kind of like, I kind of see that as a progression to almost taking the company fully public, right? If you do an IPO, you have to do a lot of that as well. You have to do all these independent auditing and things before you take the company public. So it's a progression toward that. And I think what the SEC is trying to do is basically make startup investing available to the general public, but they have to do it in a way that they can safeguard the investors, right? And the way to do that is to increase the level of scrutiny for the company as far as reporting goes. So with CF, a little bit less requirement on the reporting. With Regulation A plus, because you're raising a lot more, they ask you a lot more reporting. And then if you take the company public, it's even more reporting. So
excellent. I see there's questions about NIH grant funding. If we can go over to Anna and talk about how you thought about assessing opportunities in the non-dilutive funding space, and some differences on any NIH grants versus SBIR grants. What would you look for as a biotech company, and how do you find those opportunities?
No, these are great questions. So how I think, at least how the biotech investors see biotech in general is all about risk. And so thinking about ensuring when you're asking for grants that you're actually asking for money to pay towards milestones that are going to de-risk the product further, I think is number one. Because I've had I've gone through grants where you're focused on getting towards certain milestones, but then you change your mind and it takes 10 months to get the cash. And so you can think about just making sure you're forward thinking. But one way I think it's important as a first-time entrepreneur, I was straight out of grad school. I still didn't have my PhD. Actually, one of the reviewers said, Ms. Moreno doesn't have her PhD yet. And I was like, okay, I will soon. The point is, you want to make sure that you add advisors and consultants onto your grants. They write letters of recommendation. Some of the initial grants, what we had was a letter of recommendation from an investor actually saying, we would be interested in this technology. It's not, obviously that they have to invest, but it's someone that sees value in what we're building. The second aspect is ensuring that you're adding this data. Even though the phase 1 SBIRs are really for proof of concept, I've been on the other side where I'm actually a reviewer on these grants, and they actually do take a big aspect into consideration that you have some proof of concept there. And the last aspect really is ensuring that it's very clear. If anyone was to read what are the aims of this grant, that they make a lot of sense. So make the English very straightforward, maybe not so much as when you publish your work, because you might have a panel of judges that are very diverse in terms of their background, and just making sure that that's there. So some of the aspects that they really score you on are innovation is a big one, how innovative this is, the team. So ensuring again that you have the right team in place. The environment, are you actually in an environment where you can actually produce the data that you're saying you're gonna do in that grant itself. And so the last aspect there I would recommend is that there are actually some programs that Connect actually can help with, to guide you towards people that can help review your grants that don't actually charge you. but actually it was also part of this program called AAP. I forgot exactly what it means, but the NIH actually gives you people that read your grants, give you advice and feedback so that you can actually have a better grant as a first-time person submitting a grant. So there are some resources that are really helpful, but hopefully that kind of helps a little bit guidance with the NIH. So far, we've gotten actually 8 million in grants through the NIH and also California Institute for Regenerative Medicine, the CIRM. So if you're in California, also take advantage of the CIRM in the sense of it's a lot faster. So you apply and you get you get your review 3 months later, and then the money comes 4 months later. Versus the NIH, it takes between 10 months and a year to potentially get that money. So take that into consideration also in terms of timing, because timing is everything. It's as we all know.
Yeah, I'm glad you brought up the timing, because that's something that I've some of the startups that I've advised had a hard time reconciling with the path they were on. And so how did you think about that, kind of longer term time frame that some of that funding takes? And are there ways to work in parallel with other funding sources that make sense as you're waiting for some of these grants to come in potentially?
I think first and foremost, we submit grants in each cycle that we can. So, make sure that you're submitting in each cycle. I think the NIH has 3 a year. The CIRM, depending on the grant, has 2, sometimes 1. So take that into consideration when you're thinking of fundraising. Always be fundraising. So we're always speaking with investors, always speaking with pharma, and always obviously looking at non-dilutive funding. So nothing's ever certain, and it's always the case where not until the money's in the bank, even the grant, even the investor, even if you have a term sheet signed, not until the money's in the bank. So always be fundraising. And for us, it's also been an interesting journey, because even if you get term sheets, you might not like those terms. You might want to wait until you get towards the next investor, the next milestone, or you advance the program further, so that you get more value also yourself as part of that. Working with that investor as well. So I think for us, the non-dilutive funding has really allowed us to continue to de-risk the program, so that's more attractive to potential pharma and potential investors, and just aligning those milestones and those goals. And in terms of timing, I think what's helped us as well is asking for different grants that support the program in different milestones, different stages, so that the program is itself pretty well funded, and we don't require that external funding right away, so we can make the right decisions in terms of what makes the most sense for us.
That makes a lot of sense. And Denise, hearing what John and Anna have done in just alternative capital, how does traditional investment, when you want to go potentially back and raise a higher dollar amount from VCs, how do they look at the equity crowdfunding and non-dilutive funding coming into companies before the investors get in there?
Yeah, no, great question, Andy. I think in terms of non-dilutive funding, I think it's a bonus. Not only you've gotten generally further than you would have, and you haven't given away anything of your company, which makes it easier to structure a new financing. But also it's a little bit of a validation that somebody's even if it's a different type of agency that funds you or a type of investor, it is a level of validation. So it's definitely a positive. Some of it applies less on the tech side, so it's less relevant, but if it is, it's fantastic. In terms of crowdfunding, I think it really depends. And John was mentioning the fact that he actually used both the Kickstarter and the crowdfunding process as a way of finding customer. And so what I'm trying to say here is I think it depends what problem or market or what product you're actually building and whether that kind of fits into it. If you're consumer facing, I think there'll be a tremendous amount of value in using those type of fundings because it can also help from a revenue or customer perspective. I think where maybe to some of the negatives could be is if there isn't or there wasn't an overall strategy applied in the long term of where your financing or funding is going to come from. And it shows by which you've had several rounds of crowdfunding, which then sort of seems as if you had no other choice. I will say crowdfundings aren't always the cheapest, even though it might seem like you can get some easy money. That those platforms also take fees, And so the answer is it depends, but I think it's not a negative per se. It's not a positive per se. But if you have a clear strategy and saying, hey, I'm doing my first tranche here, and then I'm moving on, I think that's great. If it turns to be a repetitive process and we had to go back to this platform and then we went to that platform, then it's probably more of a concern as to whether you were not successful going to more traditional venture firms raising capital.
That makes sense. And I'd like to get into kind of the current funding landscape as it sits in the last 8 to 12 months. But before we go on to that, I just love to give John a chance to, having been through your funding journey, what are some of the scars you have from this process? What would you do differently if you could do it all over again?
I think what Anna said is true. Always be fundraising, because you never know. And the market changes quite a bit. I mean, obviously the pandemic hit, nobody knew that was coming. There's negatives and positives of that. For us, the positive was that a lot more people were spending time on the internet, so our sales went through the roof. The negative is that it was hard to raise capital, even at that time, because we weren't able to go out and meet people. And a lot of the firms just shut down, right, for about a year or so before it opens back up again. I think some of the things that I would have done differently. I think that's one of the things. Just start raising capital before you need it. I think sometimes we waited a little bit too long before we started the effort. And the other thing is, also to do some of the things in parallel as well. We kind of stopped reaching out to VCs during that time. We should have probably been doing that in parallel, in addition to our equity crowdfunding round.
Excellent. And I'm seeing a couple of questions on, like, how did you choose Seed Invest as your partner for crowdfunding, for equity crowdfunding? I know there's a lot of others, and what are the things you looked for there?
That's a really good question. I think we kind of just happened upon it, to be honest. But having kind of a little bit of time to think about it, the Seed Invest was a recommendation from a connection, and it was kind of a right fit for us because we had a good product. We knew that also that our customers would come on board, but also at the same time, Seed Invest was a little, there's Start Engine, Seed Invest, WeFunder, Republic, and they all have their pros and cons. But for Seed Invest, they don't take as many companies on their platform, so they typically have about a dozen or less raising capital on their platform. But their audience is also less than some of these other platforms. However, there is a little bit more focus, and they work hand in hand with you on the raise. So with a lot of these other platforms, you're pretty much on your own, really. And you'll see there's hundreds of companies that are raising on that platform. If you do really well on some of these platforms, you kind of float to the top and you get more visibility. But more often than not, 80% of the company, or maybe even higher, are just people never see those raises.
Makes sense. And on a certain similar question to you, what would have you done differently, kind of knowing what you know now in the process of trying to find funding?
Yeah, I think one of the earliest mistakes my co-founder and I made was that we had an investor mention that they wanted to put in, I think it was $3 or $4 million, and we were really confident with this person. But again, always be fundraising, right? Until the money's in the bank, even if you have a term sheet again, it was just something he vocalized. So that was one thing that we spent a few months without really pushing towards other investment fronts. And then the big one for me, like the biggest scar, I would say, the deepest scar, and it does have to do with the market conditions, so it's kind of intertwined. We were raising a 50 million Series A, and we had 3 term sheets. We signed one of the term sheets, and then 4 weeks later, the investor came back and said, look, market conditions are not doing really well, and it's taking a lot time, like a really long time to get a co-lead, and they pulled back. There was other aspects to that I learned later on, and one of them was we signed the one that had the biggest pre-money valuation. And I always get this advice that, from a lot of people, and and I don't think it resonates until it happens to you sometimes. And the fact is that just don't always focus on valuation and dilution, right? Really focus on what's the partner that you think is going to be the best to work with, right? Who's going to actually support the company, think about the next round of financing. And one of the issues with this investor was not just that they, not just the pre-money valuation that was really high for other investors, but also the fact was that in biotech, what we noticed is this was mostly a tech investor, and they kind of didn't want to work with a tech investor. Biotechs did not want to work with a tech investor. So it's something else that we learned along the way. If I thought about it, but not looking backwards, I would have picked the one with the lowest valuation, actually, out of the three, because this investor is, has a really great success rate. They really think about building out the company and supporting the company along the path. So I think that's my biggest lesson learned, is just, you are also doing your diligence on the investor. So do your diligence on the investor, not, they're not just doing diligence on you.
Yeah,
Can I add to that?
Yeah, absolutely.
Yeah. So I couldn't agree more with Anna from both sides. And the reality we always say is, especially on the early stage side, you actually almost get married to your investor. And just like that, you don't just make a decision on the whim because on the face it looks fantastic, right? Fundraising, building a company is a journey, and it's typically a long and up and down journey. It's never just to the up and right, or very rarely just to the up and right. And different complexities come along the way. It's most likely also not your last investor you'll have. And so it's just really important that you partner with the one that's clearly right today, but also can be your right partner going forward. And to the point, sometimes it's also like a matching thing. It's not that an investor is bad or the company is bad. It's just making sure it's something that fits together. To your point, is it the right industry investor? Is it the right connected partner for what you're doing? Do they have the right vision on how we're going to build this company? Because that's going to be important again as you're going through the cycles of ups and downs and being aligned through those parts of their life cycles.
Excellent. Yeah, that value add that investors can bring to the relationship, that's just so important to think about. It's not just a transaction, it's a relationship. Well, I'd love to spend a little time with everybody talking about how you've seen the funding landscape change in the last 8 to 12 months. John, if we could start you off, what have you seen out there? Challenges, great things, whatever you're seeing out there.
I do think the landscape has changed quite a bit over the last few months. A lot less, interest. And so, and I don't know if the rest of the team has seen the same thing, but just the economy itself is, there's inflation, there's lots of risk in the market, so interest has been lower.
Yeah, certainly I've been seeing that on the angel group side. It seems like people have been hunkering down a lot more on angel, less risk tolerant. I don't know, you're seeing similar things, or what are you seeing out there?
Yeah, I mean, it's interesting. When we started the company, it was very focused on pain. I learned that investors don't like pain and that they love platform technologies. So we in-licensed additional IP to actually make it platform technologies, but we can go after multiple indications. But what I've noticed right now in biotech, it went from, platform technology in height of 2020, 2021, where we were seeing 100 million Series A's in biotech every other day, to now really honing in again back onto indications, like really focus on indications because they're a lot less expensive, like less capital expensive, and a lot more focused. So I've seen that shift of going from, platform technologies to asset-centric investments. It's definitely a lot more quiet as well. And, one of my friends works with a really big biotech and investment firm, and he mentioned they haven't seen any new companies since last year. So they've all been focused on their own portfolio companies, thinking about how to extend their own runways, right? How to extend those runways, how to look for, pharma partnerships for those companies to bring in a non-dilutive funding. And so that's another aspect. Right now, it's a really tough time to fundraise, I would say. Not to deter anyone from doing so, but this is why we're here looking at alternatives and being creative, right? Thinking about, if it's not non-dilutive funding, can we think about the family? How I found family offices is through conferences. Some conferences will have family offices actually show up, and you can talk to them one-on-one. And so just, or even thinking about if you're going after a specific disease, looking into, do they have a specific, association, for example, fighting blindness is one of them, or Duchenne's association. So thinking about those patient advocacy groups is another way of thinking about finding this non-dilutive funding and that support. So yeah, definitely everyone's being really creative, and there's a lot of M&A action right now in pharma. A lot of people are looking for M&A, merger and acquisition with other companies, and a lot of companies actually going belly up. So it's just about being creative right now, I think.
And Denise, you likely have the widest view at all stages of funding on this. How have you been seeing the market affect startup fundraising, and what's your advice for folks in that landscape right now?
Yeah, I think we've just 2021 was just an abnormally, and we're sort of going back to pre-pandemic levels. So it's actually not that there isn't any funding getting done. It's just what we've seen in the last couple of years just wasn't normal, right? But when you look at actual numbers, yeah, valuations are down 50%, right, in the US, 80% in Europe. So we just have to level set of what expectations are, and deals do get done at those things. I think in terms of Anna, you're talking about kind of platform focus or to the focus shifting. What I'm seeing from shifting, generally speaking, is less focus on the hockey stick. Hey, in 3 years we're going to be, this huge growth. We got to be a growth company, right? That we're still in the venture world, but we got to achieve that reasonably, where we're not just dropping in $100 million and eat it all up with all our IT costs. So it has to be a reasonable way of how we're achieving our goals, so that in case actually the funding world doesn't get better, or these companies are actually sustainable companies on their own, which in reality they actually always should be, right? It's just funding, if you think about it, it's just a short-term means to get a business to a standalone successful business. I think it's gotten out of proportion of how long that short term is, and what big of the gap is in getting there, or where the end point is of where it reaches that independence. But we're going more back to that model of reasonableness, I guess I would call it. There's no doubt on the debt side. I mean, I think everyone is aware of the banks have gone under. That has had a tremendous impact on new credit being issued to startups, and I think that has a trickle effect on the equity side and other funding sources. I don't know the answer in terms of how that's going to be filled long term by other banks or capital sources, but in the short term, that will impact the total amount of dollar available to a startup overall from an ecosystem standpoint. Probably again not relevant for early stage, but in the wider life cycle, that has an impact.
Yeah, and on that, I have portfolio companies that are looking at revenue-based financing or asset-based financing and taking on some debt in order to get through a tough time. I see there's a question around that too. Do you have kind of a view on where that's at in the ecosystem right now, based on what's happened, this year, basically?
Yeah, I think we're, if you want to call it, we're in the whitewash of what all happened, right? And we'll see how it shakes up long term. And I think in the meantime, you're going to see some good actors and bad actors, right? Some good actors that actually want to fill the gap and provide a good product to startups, and then there's some bad actors that take advantage of the true need of companies, or the companies being desperate and needing some really bad capital that's really only going to hurt the companies in the long term. So I think it's going to take some time to weed through those good and bad actors, I think, but in general, to your point, I mean, there's revenue-based models that work really well and have worked well, been around even previous this situation.
Yeah. Yeah, I think that's important to remember too. It's you always have to evaluate those partners in the deal and make, you know, the deal decisions that make sense for where you're going. Certainly.
Yeah, and you'll see that, like, I think there's part, again, I mentioned valuations are down, Anna mentioned funding is down, but there's a level of, okay, this is actually a reasonable term sheet or reasonable financing offering to you versus I understand the desperate situation you're in and I'm going to take advantage of you. Those are two different approaches, and I think it comes through pretty clearly as you spend time with those investors and which side that investor is.
Mm-hmm. Excellent. John or Anna, do you have any other pieces of the puzzle for kind of your take on what you should be looking at in the current climate?
Yeah, I think for us, it's definitely being, like I mentioned, being creative, right? Like speaking with, you know, pharma companies are interested in one of our programs, speaking with investors are interested. We went for our Series A, but now, like Denise was mentioning, we're going for a seed, you know, to really de-risk before going for that larger round. So just being flexible about how much you're raising, as long as it progresses the company, I think is key. And not being stuck with a certain idea that I must get towards this or else it's not a good deal, like Denise mentioned as well. And lastly, obviously, we're always looking at grant funding and so on. And the last aspect too would be, because we do have a platform, looking at potentially, you know, new programs to fund with grants as well. So yeah, just being creative and thinking about all options and what's the best options for us to move this program to the clinic is always what's in my head.
Excellent.
Yeah, I think for us, you know, we're also looking at strategic partnerships and looking at strategic investors, people that we can partner in the marketplace and also get some additional investment from them as well. So not the traditional investors, but looking at more strategic. And the other thing, I guess, for us is you know, like Denise said, it's not about growth at all costs right now. So we're looking at how can we sell more subscriptions, how can we drive that more and sell more software services. So kind of moving more toward the software side of the business, which is higher margin business for us, and working on those metrics so that it's better positioned for the next round.
Yeah, I like that you brought up finding strategic partners, because there's a variety of ways you can make deals with strategics that enhance the longevity of your company and really drive the mission forward also at the same time. So how do you approach identifying those companies, and then how do you communicate with them you know, at the outset?
Through LinkedIn, through your
I mean, that's good.
So find the right person at the company. Usually it's somebody who's on the business development side or corporate development side, and then see if there's a good fit.
Excellent.
For us, it's going to conferences. I'm right now at the American Society of Gene and Cell Therapy. So it brings together, obviously, all companies interested in gene therapy, right? So we understand who's looking into the space and talking to VD, like John said. But I also find that in biotech, finding an internal champion on the science side is really important. Having a scientist in the company that understands what you're doing and sees the value and how that does compare to other technologies or even internal programs, I think is really key. And also, I think speaking, right? Doing conferences, speaking about your science and going out there so you're exposed, so more people know about you, I think is also important. Because if you're just in the lab, no one's going to know what you're focused on. So, and then lastly, obviously go through your advisors, you know, people are always connected. They know someone that knows someone, or they're just directly connected to someone on that part of that company. And also always be up to date on the news. So in biotech, it's endpoints and fears biotech, and we understand, okay, what programs were cut from this pharma company. That means that Takeda just actually is right now out of gene therapy. And we know that this company started focusing on pain. So just trying to follow what pharma is interested in and just hone in your efforts on those companies, I would say.
I was going to, one thing I'd like to add is that's one of the benefits of doing crowdfunding, is that equity crowdfunding, is that we now have a few thousand investors. and one of them might be connected to a company that you're interested in talking to. So we've gotten connection through that as well.
That's excellent. Okay, great. Well, I'd love to continue through some of the questions from the crowd. If you've been listening in and haven't asked a question yet, feel free to put that in the Q&A section. One of the questions here is talking about looking at corporate venture funds and getting access to those. And I think that's highly relevant to this kind of strategic path that we're talking about. How do you identify and look at, you know, corporate venture as a part of your fundraising strategy?
So similar for us, you know, big pharma typically does have venture arms, and it's another way of finding out. Sometimes they're separate, meaning doesn't matter what the actual big pharma is focused on, as in their turtle programs, they might still invest, but they act like typical investors, I would say. I don't think it's much different than a VC in the sense that they have what they're focused on. They might be less sensitive to valuation is the only thing, but they typically don't lead. So it's all about finding that lead. I would say focus on the lead investor, and then you can fill out the round with the rest of the people. How we found them, and sometimes it's cold emails, sometimes it's through advisors that know someone, and sometimes it's through the investor that's actually interested in you. If you find a good lead, they will also introduce you to other investors that will be part of that round. So I think it's another way that you can also understand if you have a good investor as part of your team, is just seeing how they respond. But I don't think they're much different from other investors in the sense that, you know, they still have certain focus that they're, you know, working on, but they don't lead. And that's the word that you always hear. You need a lead investor. And that means that that's the person that's going to give you that term sheet, that's going to be in charge of having a board seat, and bringing other investors into the round.
Excellent.
Yeah, I mean, we've had a company that invested in Gryphon, and that was more through a partnership that we did. So we were partnered to kind of take the combined solution to the market, and as part of that deal, they also invested in the company. But
Gotcha.
Other than that, you know, we haven't done anything outside of that. But I agree with what Anna said. It's some of the corporate funds that we talk to, they don't typically lead, but they will come alongside if you have a lead.
Gotcha.
I think this is the broader question is like, why are you going after certain sorts of capital? Of course, you need capital, therefore you're fundraising. But what are you actually trying? Like, why are you going to corporate venture arm? And to Anna's point, there's certain corporate arms that specific, they act in just like another venture firm, except that they don't lead. But there are corporate arms that actually do it as an early step into their M&A process. And so from that perspective, if you are building something that for certain companies is just not possible to build in-house, and it's just cheaper and more efficient to acquire, and it's relevant for them, then those would be probably the most ideal corporate venture firms, corporate venture arms you want to go after. And that takes homework understanding of what are the big, you know, companies in your space. What are they doing? What are they not doing? What have they publicly stated that their missions and their strategic plan is, and how do you fit into that?
Got it. I'm going to consolidate a couple of questions. It seems like folks are asking, in general, with the really early stage, call it idea stage of creating a company, you know, how should they be thinking about when to fundraise, and what should they do to be ready to approach more traditional capital? You know, where should they get to for some of these different stages that we've identified, angel, seed, A, those types of things?
I'd be happy to start. And again, this is going to be slightly different for the life sciences space because the stage of fundings is a little bit different. But generally speaking, and especially in this market, it's very hard to raise capital from an institutional fund based on an idea only. You either have to be a serial entrepreneur who's a proven track record in executing, or it's just really tremendously hard. And the reason being is that, you know, that it's just the de-risking component of it's just so hard when it's just an idea and you can't do any due diligence on anything, right? But so on that note as well, depending on what you're building, you don't need to raise funding for quite some time. Sure, there's some cost involved in incorporating, and depending if you're building a software, but presumably it's not only what you're bringing yourself to the idea, it's not just the idea itself, but it's some sort of competitive advantage of how that makes you unique in building that. And that should get you, so that possibly is the actual know-how in doing it. And so that's your own time that in the beginning, investors want to see that you've already committed to before you ask them to commit to you, right? So there's a little bit of that. And so even though you don't want to be too late to the fundraising side, I do think there is a level of work and commitment that you have to prove that you've done before approaching investors. And that applies to angels as well. It's very hard for angel to commit to something if they haven't seen your own commitment, and your own commitment can be in the form of time or capital, or both ideally.
Yeah, as an angel investor, I look for that proof of concept or MVP. And I also look for team. Have you spent time building the right team around this idea? Why you all, and as a team, is a question that I want to answer before engaging in an angel investment. And that team should show some level of just unfair advantage to the space that they're in, the solution that they're trying to provide. Any other advice from the others on early stage?
As Denise mentioned, biotech is a bit different. I mean, it's so expensive, right? Just going through an experiment, you might all know. But there's different kinds of investors. Some of them are really early stage. So for example, Third Rock or Flagship, they like to come to the universities and look at the IP, and then either in-license that technology itself, or bring you as a founder along, but really help you build up the company. So it can be really early stage. I think the most important question is always around IP. Do you have IP that's actually been filed, right? I think for me, that's where I would start. Do I actually have IP that would actually create interest from investors? And then if you want to be the bootstrapping it yourself, like my co-founder and I, and being part of the company, I think what's helped us is getting towards that non-dilutive funding and de-risking and showing that people believe in science and the technology, the science makes sense before getting that investment interest. And so also thinking about the stages, you typically seed is to get towards that in vivo proof of concept, that in the animal model. Whereas the Series A is going towards some clinical data. So what stage are you on? If you don't even have in vitro proof of concept, you're more of a pre-seed. So just thinking about what stage you are at, what other experiments you need to do, and always think about how much money am I raising, and is it sufficient to actually create value in different milestones that I need to fulfill. So just thinking about, again, not just asking for money and just throwing out a random number because others are doing it, but really thinking about how are you actually going to use that money to execute upon those milestones to get to the next stage of fundraising.
Agree with all of that. Sometimes it depends. I guess it's.
And I guess let's leave it with, because we're running out of time here, but how do you get access to mentors and advice on who to approach? How does it depend? What does my scenario look like to the outside? Those are all things that it's tough to know as a first-time founder, certainly, and you kind of need an advisor there. So how do you approach advisors?
Connect was very helpful. We went through their Springboard program where they connected us with a bunch of advisors that helped us with the deck and what to put on there, and just going to some of these events in San Diego helped.
For me, it was actually through the Rady School of Business. So while I was doing my PhD and start thinking about wanting to start a company or to take some classes with the MBA students, and then through there met some mentors. One of them who's been in the biotech space for 40 years. Other mentors and advisors we've met through, for example, one at J Labs, he was a CEO of another company. So if you're a CEO of a new company, look for other CEOs because they'll have those lessons, and it's also very lonely, right? And then actually throughout the route, I've had investors introduce people to us as well. So the longer you're at this, the more advisors you're going to create around you. But how I think about advisors is always looking at, in general, as my team is kind people that are actually good people. You're really at the bottom of this. And if they start asking for equity, like the first conversation you have, I run away. I feel like you need to get to know them a little bit and see that they're interested and you're interested in getting that chemistry to ensure that it's going to be a good relationship.
Excellent.
Yeah, just adding to that, what Anna said, I think if you're coming out of a school system, there's very early stage programs in each of the schools at this point, which will help you on the early stages of like how to get started, how to get incorporated. There's mentors available with all that. I think as you get more into the seed on the tech side or the A space, or really the seed stage, it's finding mentors that have an activated network. So when you come from the academia, you're surrounded generally by unbelievably brilliant folks, very successful folks, but not always connected to the current industry. And what is important as you grow, you need the clinical, so to speak, mentorship first, but then you also need the active industry mentorship that can actually connect you, whether it's with investors or a buyer of your product or the industry you're trying to get into. So keep that in mind too. Like just because somebody has a tremendous amount of resume and they've been unbelievably successful, which is, impressive, make sure that they're also connected and can help you to get to the next stage. With sometimes just picking up the phone and making it happen for you is one of the most critical things you can get out of a mentor.
Awesome. Well, thank you all so much. I want to make sure we're staying on time, but I really appreciate all the advice and just your stories in coming to your respective spaces and how you've navigated different challenges in funding. And I really enjoyed learning today as well. So thank you so much.
Thank you.
Yeah, thank you.
Wonderful. My gosh, I learned so much too here. Thank you so much, Andy, for being such a great moderator and for all your sage advice to you and John and Anna and Denise. It's been just great having you here, sharing your stories and your journey and providing some, great insights and advice for other innovation startups out there and helping them, keep things in mind when considering different funding routes. Thank you, everybody, for joining us today. I hope you found today's webinar insightful for the companies that you're building. This webinar is recorded and will be made available to everyone who signed up. We hope to see you in a future session on Capital Insights, and wishing all of you a wonderful day wherever you may be. Thank you so much.
Thank you. Bye-bye, everyone.